Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
The US Fed held rates steady but flagged more tightening ahead. And markets finally caught on that the central bank is deadly serious about taming inflation. So, are we entering a new era of higher for longer interest rates? As Greg Canavan and I mentioned before, when consensus forms in markets, it pays to listen to your inner contrarian. Yes, rising bond yields do suggest investors are more confident inflation can return to target without a sharp slowdown. But how confident should investors really be? As Milton Friedman once said, it takes time for inflation to be cured, and unpleasant side effects of the cure are unavoidable. What's not priced in? The extent of those side effects. Hello and welcome to the 18th episode of What's Not Priced In. It's obviously a little different setup today. I'm joining Greg remotely. I'm not at the office as I usually am, and that's because I have finally caught COVID for the very first time, but I'm all good. Greg, I hope you're feeling better than me, and welcome to another episode. Yeah, I finally made it.
Thanks, Kirill. Yeah, well, everyone's going to get it at some point. Can you believe they shut down the country for it? But anyway.
Yeah, well, yeah. I think everyone of my friends seems to be getting it, so there's definitely another wave. But yeah, the mood is definitely different now than it was 2 years ago. But
that's for sure. Let's be thankful for that.
Yeah, exactly. But this isn't a COVID special, so we'll definitely talk about the latest moves in markets, and obviously the biggest thing this week has been the Fed decision. Obviously, no surprises there. The Fed did hold rates like most of us expected. Interestingly, there were 12 officials that did pencil in one more hike for the year. 7 are ready to sort of pause until the year is done. And the median participant forecast is that there will be 2 rate cuts in 2024. So, Greg, what do you make of it, and what do you make of the market moves in response?
Yeah, I thought it was all pretty interesting. So the actual headline wasn't much different to that expected. Obviously, the Fed kept rates on hold and held out the likelihood that there could possibly be one more rate hike this year. And then obviously probably the biggest change was that they increased their GDP growth projections. And on the back of that, pulled back on their expectations for rate cuts in 2024. And I think that's what the market was responding to. I think one of the more interesting things was that, this, and we talked about this last week, that the higher for longer narrative is now getting baked into prices. And I think that was just another layer of that happened today. So the interesting price action, though, was that the NASDAQ, for example, really got spooked by that and sold off. But if you're thinking that higher for longer was the reason for the NASDAQ's fall, then you didn't see a big move at the long end of the yield curve. So the 10-year bond yield didn't really move higher, and gold prices didn't fall either. And if you're thinking higher for longer, then I would expect gold to have been quite sensitive to that move. So if I'm trying to rationalize those different moves, then I'm sort of thinking, okay, and to sort of put some context around this, the Fed is nearly always wrong in terms of its longer term projections and wrong at turning points. And that's not like a criticism of the Fed. That's just a criticism of the difficulty of long term forecasting. It's very difficult to get that right, and especially for effectively a political organization that is incentivized to paint a very narrow consensus picture all the time. So they're trying to paint a picture of a soft landing or a no landing scenario. But if you look back in 2007, at the last time, just before the markets cracked lower, the Fed was projecting higher inflation or persistent inflation, higher interest rates, just before they had to cut and the economy fell out of bed. Not suggesting we're in the same situation as a looming credit crisis that we had in 2008, but I am suggesting that the market or the economy is probably going to slow a lot more than what the Fed expects in the next 6 to 12 months. So, and I think that's where you can interpret the bond market and the gold market is saying, okay, if you guys are going to keep interest rates higher for longer, sure, the short end will move up to reflect that, but the long end of the curve is going to say, actually, you're going to create a slowdown because of that, and will probably bring about a reduction of interest rates sooner than you think. So, in saying that, the market didn't necessarily price in interest rate cuts for next year. It's starting to pull them out, which I think is fair enough because the Fed is adamant that they're going to slow the economy in order to get inflation back to 2%. And that was, to me, the sort of key takeaway from Powell's speech is that he said, we need to slow the economy to get inflation back down to 2%. A slower economy means lower company earnings, and it really doesn't justify the high earnings multiples that we're seeing for many companies in the S&P 500. So, yeah, that was my. I guess that was my brief interpretation of the FOMC meeting, and obviously our market has responded to that negativity today. I think we're recording this around midday or just after lunch on Thursday, and our market's down quite heavily, the banks especially. So, yeah, I mean, clearly, I think the market is starting to think the Fed is serious about keeping rates higher for longer. The Fed is serious about getting inflation back down to where it needs to be, and it is serious about causing an economic slowdown in order to achieve that. Now, whether it is pretending that it's not going to cause an economic slowdown by keeping these projections into 2024 GDP growth predictions pretty rosy or not, who knows? Maybe they actually believe it. But, and we can have a look at this in a minute, but some of the leading economic indexes and indicators are suggesting that a slowdown is going to be quite sharp and possibly imminent. So, yeah, that's the takeaway, the key takeaway.
Yeah. No, thanks. And I think with our own Reserve Bank, we've also this week they released their latest meeting minutes. Obviously, they also kept their rates unchanged. I think the language sort of did change a little bit in the meeting. I think the last few times that they held rates steady, they did say it was a balanced decision. It was sort of a close call between hiking by 25 basis points or not. I think in this one, the language sort of changed a little bit in that the decision to hold was a much stronger one. So that they felt like it was a much easier decision to hold rates where they are now and just sort of wait and see where things go from here. And obviously we like to say on this podcast that monetary policy acts with a lag. And I think in the recent statements and meeting minutes, that's sort of the message that the Reserve Bank has been saying internally as well, that they sort of don't want to push things too much because they still feel that the full brunt of the monetary policy hasn't yet been felt in the economy. And I think there was an interesting thing. We sort of like to point out how much the Aussie households have been struggling. I think the Reserve Bank in its meeting minutes noted that the average outstanding mortgage rate in Australia is now higher than in several other peer economies. And that's despite the fact that the policy rate in Australia is somewhat lower than other advanced economies. And that does sort of implies, and I think we've mentioned this before, Australia is a little bit different in that we really do feel the rise in interest rates much more than other economies like the US and the UK, and that's because of the variable interest rates. And speaking of the mortgage rates, the Reserve Bank did say that scheduled mortgage payments rose to 9.7% of household disposable income in July. And that's, again, another record. And the Reserve Bank does think that this will actually go higher in the months ahead. So things are not really looking that great, and the economy is definitely slowing down.
Yeah, and as we sort of spent a bit of time talking about last week, is that we are towards the end of the fiscal stimulus from the COVID, I guess, all the benefits that the government bestowed upon households from COVID. We're sort of getting towards the end of that now, and you've seen that in households running down their savings. So I think someone left a comment on the YouTube page under our episode last week asking about the effect of fiscal policy on monetary policy, and I think the clear message there is that monetary policy, the tightening has been stunted somewhat from the stimulus from the fiscal side. And my argument is in the next 3 to 6 months, you're going to see as the fiscal side stimulus moves away, the real tightening is going to bite on the monetary side, which is where I'm coming from with I think you'll see rates falling and an economy slowing faster than what the markets are currently expecting. And I mentioned before the leading economic indicators, and I think it's worth just showing yesterday the Westpac leading economic indicator or leading index came out for the Aussie market, and I'll just read from the press release here, just to give you a sense of what it means. It says the 6-month annualized growth rate in the Westpac Melbourne Institute leading index, which indicates the likely pace of economic activity relative to trend 3 to 9 months into the future, rose slightly to minus 0.5% in August from minus 0.56% in July. So it's still negative, but just slightly less so. The economy continues to move through an extended period of weakness. Despite another slight improvement this month, the leading index growth rate continues to track in negative territory, the measure having now been below zero for just over a year. Negative prints for the index indicate the economy is likely to grow at a below trend pace. This string of negative prints began in August last year, accurately foreshadowed the sudden slowdown in the economy in 2023. Over the March and the June quarters, the economy has expanded at a 1.6% annualized pace, which is well below trend growth, which is closer to 3%. So essentially, this leading index is saying not necessarily that we're going into recession, but the economy will continue to grow below trend, which brings us to inflation. Now, I will get onto that in a minute, but I'll just, while we're on leading indexes, I thought we'd just show the more pronounced one. This is the Conference Board, a key US leading economic index indicator. This is this is only showing to the end of July. So this is from a press release in August, and they haven't released one for September as yet. But you can see here that the leading economic index has continued to fall quite sharply. And it's getting towards these points here where you saw recession in 2001. Clearly, it was very big in 2008, but it was starting to fall in 2007. And even at this period in 2008, up until here, everyone was ignorant of the fact that the US economy was in recession. I don't think the recession was actually declared until well after. So we are now into that sort of realm as well. Yet GDP growth in the US is continuing to be quite strong. So I'll go back to those comments about fiscal stimulus. And I think the fiscal measures in the US were just as strong, or if not stronger, than in Australia. And those measures are in the same situation where they're washing through the US economy. Household saving rates are now at very low levels, so there isn't a lot more to go. And we talked a couple of episodes ago about the San Francisco Fed and the studies that they've done showing that those buffers would be run down by the end of this month. So we are not far away from potentially seeing this turn down and closing this gap somewhat with the economic indicators. Now, going back to Australia, or this comment here in the Westpac leading indicators suggesting that we're going to get below trend growth for another couple of quarters, sort of takes me to the point about inflation. And everyone's talking about, inflation is going to be sticky. We've got rising energy prices that are feeding that narrative as well, because everyone knows that rising energy prices are passed on, and that causes inflation. And I disagree with that. I think what you need to focus on is the monetary side of things. And I had a look today, and if you look at the key indicators of monetary aggregates that the Reserve Bank of Australia publish, so I just looked at the last 6 months of these releases because obviously the last 12 months in the prior, or the first 6 months of the last 12 months, monetary growth was still quite strong. So if you strip that out and you just look at the last 6 months and annualize it, you've got broad money annualized at 2%, and you've got M3 annualized at 2% as well. So the monetary aggregates are coming down. You've got economic growth at below trend, and below trend economic growth suggests that you're not going to get an inflationary breakout. And talking about higher energy prices and whether that will lead to inflation, I guess it depends on whether you think companies have the pricing power to pass that on. And in some cases, they obviously do, but in many cases, they probably don't. So you're going to see a lot of this higher energy or higher cost absorbed into margins and things like that, which again is going to be a headwind for the market. So, and that was, my comment there, higher energy prices absorb liquidity in dollars in a tightening monetary environment. If, for example, the Reserve Bank was to turn around and start cutting interest rates quite aggressively, then I would expect, inflation expectations to pick up. But while they're staying quite tight, and you're seeing these indications of, monetary aggregates coming down, then that suggests that there's going to be bites somewhere in the economy, and that will more than likely be in company margins. And just to show you again, these monetary aggregates, this is from the latest Reserve Bank data pack. You've got M3 falling quite sharply. Currency, not huge sort of follower of that. So even though that's negative, I don't think that really means a great deal. But you got M3 coming down at 4% annually. As I said, if you take the last 6 months and annualize that, it's down at 2%. And then if we look at the credit and broad money growth, they're coming down pretty sharply as well from that bounce higher. So yeah, that just sort of tells me that all these things are looking at, like, even though the market's looking over here saying, oh, is inflation going to be sticky? Is higher energy prices going to cause another surge in inflation? If you look over there or over here where I'm looking, all the evidence suggests that things are slowing down, and you need to be pretty conscious of that, especially when it comes to stock selection and how you're thinking about portfolios and all that sort of stuff, is that we are potentially going into an environment where cyclical companies could be under pressure again if they're overvalued. And just looking at today, the financials have taken a decent hit. The big banks are under pressure because the economy is slowing. So, and some of those banks, especially Commonwealth Bank, which we pointed out in past episodes, are priced for very, very good economic times. And I'm not suggesting we're going into recession, and the bond market isn't priced to suggest that we're going into recession. But like the leading indicator said, below trend growth for the next couple of quarters. That's probably not going to be conducive to a lot of companies and the growth multiples that they're on.
Yeah, and I'm really glad that you sort of brought up those aggregate money charts, because I was doing some reading last night. I was reading Milton Friedman's Free to Choose. It's one of his more popular works, and there was a chapter on curing inflation. And I wanted maybe to share some of his wisdom with you, because I think it directly relates to some of the charts and some what you were saying about the monetary supply. And I think the main takeaway was that, and this is his quote, many phenomena can produce temporary fluctuations in the rate of inflation, but they can have lasting effects only insofar as they affect the rate of monetary growth. And I think he sort of then goes on to reiterate, what matters for inflation is the quantity of money per unit of output. But as a practical matter, changes in output are dwarfed by changes in the quantity of money. Productivity is a bit player for inflation. Money is center stage.
Well, I guess you'd expect that from the man who said, what did he say? Inflation is always and everywhere a monetary phenomenon. But yeah, look, I think to me it makes intuitive sense that if you've got and it's a very difficult concept to put into the real world because Australia is not a closed economy. There's money flows coming from everywhere. But just if you look at, and last week we showed the US monetary aggregates, and they're falling even more sharply and in negative territory. Australia is falling quite sharply. Like, it's telling me that there's a story of there's this slowdown happening. And if you just look in your own wallet, there's less dollars in there than there used to be. So that, to me, that is just a common sense way to look at things. And I think often in mainstream media, you get these narratives that just seem to get a little bit of traction, and one of those is oil prices up, therefore it's going to be inflationary. And I'm not sure whether people have really put a lot of thought into how that necessarily works. Yes, it's inflationary if there is an increase in money to absorb and allow those costs to be fed on into the system. So this is where, and this is why, in cases where there's monetary tightening, higher oil prices can actually lead to recession. In terms of, that is the cause of recession, and in many ways, you'd probably argue that 2008 had a lot to do with that. I think back then, oil prices went to over $150 a barrel. They sort of spiked into that recession. But clearly, if companies can't pass that on, then they've got to absorb that hit. And then it gets to a point where demand just goes away because there's not enough demand at those prices, and the demand has to drop in order for the price to drop. So a different situation now. I think oil and energy is a very different situation than what it was back in 2008. We've had big restrictions on new supply or finding new supply. Politicians think that windmills and solar panels are going to power our economy. We don't need to look for anything else. I think Victoria's banned exploration for new sources of gas, even though gas is absolutely essential to firm intermittent renewables. So there's all sorts of crazy stuff going on in the world of energy, which I think is going to underpin higher energy prices for some time. But if we just take a look at some of these energy prices lately, I think you'd probably say a reasonable person would suggest that it might be time just to sort of settle down a little bit on the energy front. Like, if I look at, this is the Brent crude price. It's done really well. We showed this last week. It's sort of moving out of this long-term downtrend, which I think is really bullish. But it did get into this overbought situation a couple of weeks ago, and it's only just starting to come out of that now. So we did see a bit of a pullback last night. Wouldn't be surprised to see this sort of correct, purely because the amount of analysts I've seen coming out in the past few days saying oil is going to $100 a barrel and more, which I completely agree with, by the way. But just in the short term, as soon as everyone starts saying that, you think, okay, well, who's left to buy this and push it over $100? So I wouldn't be surprised to see this correct a little bit. So if you don't have energy in your portfolio, maybe just, what I always tell my subscribers, and I've been in these energy stocks since 2021, buy on the dips. You can lighten up on these rallies when everyone's getting excited, but on any sort of correction or dip, you can sort of add back to it. But if we're talking about crazy, the uranium ETF, this is the Better Shares Global Uranium ETF, just gone completely off the charts in the last few weeks or month or so. This is an ETF that I've had on the watch list. I sort of got onto it a little bit too late, and I was hesitant to buy into it. And I said, let's wait for a pullback around here, or it might have even been around here. I can't remember, but it didn't. The pullback didn't happen. It just kept going up and up and up. And here you can see at one point the RSI got to over 90, which is, it's a very, very overbought level. This is clearly going to come back down. So again, I just sort of say exercise patience and wait for a good opportunity to buy back in. But the whole reason behind the uranium price spike is a sound one. The global policies around the world are, for net zero is suggesting that there is absolutely no way renewables are going to do the job. And if you want to get to net zero in a low or zero emissions way, nuclear must be a part of that equation. Chris Bowen in Australia is doing his best to pretend that's not going to happen, and assuming that there's other ways we can get there. But I think over time, common sense will have to prevail. It's happening in other parts of the world, and this is why you're seeing, everyone wanting to get into uranium stocks, because it's sort of dawning on people that this is a trend that's not going away. So I would just say exercise patience. There'll be time to buy into this trend because I think it's got years ahead of it.
Yeah, definitely.
And just while I'm on these charts, I just wanted to show quickly ASX 200. We've been talking about in recent weeks and months how it's just 1 week up, next week down, 1 week up, next week down. This is starting to narrow into a sort of I guess a break point. So either breaks higher or breaks lower. Doesn't necessarily mean it has to be a major move either way, but I think we're getting to that point where the constant weekly ups and downs, I think the market is going to decide one way or the other, which way it should go. Now, I'm not suggesting that it's 100% going to be down, but based on what we've just talked about in terms of leading economic indicators, the direction of the economy, and the determination of central banks to keep rates higher, and the fact that fiscal is starting to become less and less of a source of demand and a source of economic growth. And, to me, it just makes sense that the next move's going to be lower.
Yeah. Well, I think maybe I wanted to just maybe add about it, the rise in energy prices. I think earlier this week we also, there was a report that the average petrol prices in Australia, I think the average price hit a record peak, and I think it was like 2.29 a litre. So it's definitely very expensive at the Bowser. And I think that's partly also underinvestment. We don't really have that many refineries here in Australia, and that sort of pushes the costs up. So even if the price of oil even comes down, it doesn't necessarily mean that petrol prices in Australia will also come down sharply. It's just we just don't have that many refineries, so we'll just have to import, and that's price in. So that's just another sort of theme that you've been talking about with your net zero stuff. And also I think maybe just there's a bit of a parallel, I think.
I can't remember whether we...
Yeah, keep going. I think my
internet's
slow, yeah.
I was just going to say we're on a slight delay, which always makes things interesting. But no, I was just going to say I can't remember whether we mentioned it here a couple of weeks ago, but Australia does import over 75% of its refined petroleum, and we've been closing our refineries over the past few years. So we've only got 2 in the country. No one in the developed world, at least, is building any more, because when you have policies and policymakers that tell you that there's going to be no need for petrol cars in the next 10 years, who's going to spend multi-billions on a new refinery? It's not going to happen. So all these incentives are just way out of whack. And the developing nations that are building the capacity, obviously they're building capacity for their own economies. And obviously, we are exporting. I think our exports come from like Korea and Singapore and stuff like that. But yeah, we're not creating new capacity. And if you look at the UK, I think Rishi Sunak just said we're pushing back our, the legislation that said that petrol cars needed to be banned by, 2030, 2035, pushing them back purely because it's just crazy. You're not going to create that transition in that short space of time. So this goes back to the comment before. We're going to need fossil fuels for a lot longer than what most people expect, and probably what the market has been thinking.
Yeah. Well, and I think I was just to wrap up the discussion of energy. I think there are definitely also parallels with the recent uranium rally and the recent rally we had in lithium. Obviously, lithium is a major component in EVs, and EVs is a mega trend. I think uranium is obviously going to be very important down the future. So both, I think lithium a few years ago did a massive run up in price, and then obviously percolated to all of the explorers and developers running up in price. But then I think this year, obviously, we've had a bit of a bear market in lithium. Both the spot price of lithium fell, and a lot of lithium hopefuls also crashed and burned. So there's just a bit of parallels there for uranium. Just because the longer term view is very positive doesn't mean that in the short term it's always going to be up and up and up.
Yeah, I mean, I guess the only difference I would suggest there is that there's just not the supply
Yep.
of uranium, and there needs to be more of it mined to build up these strategic supplies because they've been run down for so long. But if we're talking very long term, the uranium and nuclear is such an efficient form of energy is that you don't actually need a great deal of it to power huge economies. So from that perspective, I don't think there's any issue with supply. And the other thing with uranium to consider is that the actual spot price of uranium is not a huge consideration for utilities that are running nuclear reactors. The price of the fuel is actually quite small in relation to the rest of the running costs. So you could get a doubling in price, and it wouldn't really affect demand so much, and it wouldn't affect utilities' outlook on whether they should keep stocking or whatever it is, because it is such a small input to the overall cost of running a nuclear power plant that it's not a huge consideration. Whereas prices, I think, for say oil and coal and gas, probably a fair bit more sensitive on the demand side.
Yep. And I think also maybe I just wanted to maybe to put one more final quote from Friedman to wrap up the discussion on inflation. So I think he had obviously said the chapter was titled "What's the cure for inflation?" And given that the supply of money is basically the determining factor of inflation, the only way you can really cure inflation is to quell the supply of money. And he says here, the cure for inflation is simple to state but hard to implement. Just as an excessive increase in the quantity of money is the one and only important cause of inflation, so reduction in the rate of monetary growth is the one and only cure for inflation. The problem is not one of knowing what to do. That is easy enough. Government must increase the quantity of money less rapidly. The problem is to have the political will to take the measures necessary. Once the inflationary disease is in an advanced state, the cure takes a long time and has painful side effects. So I think that's an interesting quote there because, number one, it takes time for inflation to be cured. It has unpleasant side effects. And I think the final one is that it does take a bit of will from governments and I think central banks to reduce the money supply, and because it has negative side effects, and it takes a bit of a strong personality to pull that off.
Absolutely, and I think that's what the market's starting to realise with Jay Powell now is that he has been saying for quite some time that they're determined to get inflation back down. Yet the market has constantly priced in these interest rate cuts coming further down the track. I think initially it was coming in 2023 sometime, and it was coming in 2024. But I think what the market has constantly underestimated is this effective fiscal that's thwarting monetary policy's ability to do its job, and the unpleasant side effect is recession, and that's always difficult for central bankers and politicians to deal with, because they're effectively, recessions generally lead to changes in government. So yeah, they're certainly not popular, but Jay Powell is doing a pretty good job, I think, in making sure that the market is not going to preempt him in rate cuts, which to me suggests that he will cause a deeper slowdown than what the market is currently expecting, which will translate into lower share prices. And look, you're already seeing that. I've got some other charts here that I was going to show before, but I'll just do it now. If we're looking at like a really cyclical industry, then travel and airlines is one of them. And we've seen recently in Australia, Qantas share price fall quite heavily. And that's coincided with a lot of well-deserved criticism over its board and its former CEO, Alan Joyce, who, if you look at how he run Qantas, then, he's left it in a bit of a massive shambles. And I've been loving Joe Aston's commentary on it in the Financial Review. Absolutely savage, just dropping truth bombs relentlessly. And look, and this is the power of good journalism. He has almost single-handedly got the market to look at this situation. But I remember we were talking, Kirill, in one of our earlier episodes of this, and I can't remember whether it was around here or whether the share price had broken down here, but we highlighted a fund manager's comments at the time who said, he thinks that Qantas is a good buy here and Qantas is, cheap and going higher. And we were saying at the time that that's, crazy talk. And this was even before, and this had nothing to do with criticisms over the management or the board. This was really about the cycle and where Qantas was in the cycle. And it had benefited massively from the post-COVID openings. It obviously rallied really strongly. And I remember saying at the time, it looked like it was rolling over here. And that's clearly what's happened here. Now, a lot of that has got to do with this negative publicity that's come out about the company. But if you look at the American airlines, they're all in similar situations. So this is actually American Airlines. I think it came out with a profit warning a week ago or something. That peaked, all these guys peaked in July. So it peaked in July, massive correction since. This is Air Alaska Group. Let's see, peaked in July, massive correction since. This is Avis Budget Group. So this is the car rental group. Obviously not as far down. This one peaked in July as well, corrected lower. Delta Airlines, let's see, peak in July, starting to correct sharply lower. FedEx is one of the few that's still sort of hanging in there in terms of being in a nice upward trend still. But this peak came in at sort of late July, early August. We've got JetBlue Airways here. Recent peak was in July. Really, really fallen off a cliff there, so it's not looking good. No, I don't know any of the individual situations of these companies. I don't follow US airlines, but it's just interesting that all of them peaked in July and they've all fallen sharply since. So that's Southwest Airlines. This one is United. United peaked in July again, sharply fallen since. UPS, this is just a United Parcel Service, peak in July, fallen sharply. So that's all the US airlines. And if I go back to this oil price, oil sort of bottomed at the end of June and started rallying. And I wonder if oil, the rise in oil price and obviously the effect on airlines because of their consumption of oil has had an impact on that. So you've got a combination of lower demand because all these money from fiscal stimulus is starting to wane. So and then you've got higher costs in terms of higher oil prices. Goes back to my earlier comment. If there's enough money flowing around the economy, then airlines would be able to pass on those higher costs and demand would remain the same and the share prices wouldn't be falling out of bed. But the fact that the monetary aggregates are tightening, people don't have as much money in their wallet, means that airlines might not be able to pass on those costs and need to start absorbing them, which is why those share prices are falling. Now, just the last thing I wanted to look at, the consumer discretionary indexes in both Australia and the US have looked pretty good. And this again comes back to this ongoing money in the pockets that consumers and households are spending in terms of their savings. So this index, this consumer discretionary index in Australia still looks pretty strong. I would point out it's dominated by Wesfarmers, so it is a little bit skewed. There's some companies that are under the pump, some that are doing quite well, but this is still looking pretty good. So I'm looking to see whether this holds here or whether we turn back down. And the same in the US. This is the consumer discretionary ETF, also peaked in July, corrected lower high here, fallen sharply. This is Wednesday night session post the Fed, so that fell sharply there. So interesting. You're going to be keeping my eye on this low here. If this index is rolling over, then that will, I guess, play into the comments about weakening fiscal stimulus and then monetary policy standing on its own and being quite tight. That will have an effect on the US economy moving forward. So I think those charts are quite interesting to give people a sense of where that really consumer cyclical and consumer sensitive industry is at the moment.
Yeah, and I think as we sort of mentioned at the start of the show, mortgage repayments as a proportion of people's disposable income is going up and up. So that just means there's less money to spend on discretionary items, and the Reserve Bank does think that that proportion of mortgage repayments to discretionary income is only going to go high from here because, as we always like to say, monetary policy acts with a lag, and there's still a bit of lag to go. So discretionary spending is probably going to get worse from here before it gets better, and that will put pressure on retail stocks. And I think just yesterday, the KMD brands reported and fell about 5% despite last financial year. The sales, I think, were record high, but I think the market is always looking ahead, and I think full year 24 sales are softening, and the market is getting a bit worried.
That was KMD brand. So what do they own? Kathmandu.
Yep.
What else is that? Are they?
I think Macpacks are all of those outdoor type of brands, but Kathmandu is their biggest one.
Yeah. Obviously highly consumer discretionary and a good case in point. So you're going to get some stocks like your Wesfarmers that, in many ways, Bunnings is almost I would say a consumer staple stock, but it's in the consumer discretionary index. But if you look at a lot of those retailers, the well-managed ones are still doing quite well. They're obviously, earning or gaining the dollars from the households that are out there spending. But I think, just to labour the point, that when the savings are run down, it's going to be a little bit tougher for consumer discretionary players out there in the latter half of this year.
Yeah, and I think maybe just to wrap up, and I think the biggest obviously theme of today is what's not priced in is maybe the greater threat of recession than the market thinks. I think in the Reserve Bank meeting minutes, the bank did note that longer term yields have risen recently, and the Reserve Bank said that this suggests investors had become more confident that inflation could return to target without a sharp slowing in the economy. So I think both the market and the Reserve Bank thinks that it can pull off a slow landing, but I think, as we've sort of shown here, the risk is still very high that the Reserve Bank won't pull it off, both here and in the US and other advanced economies, and that's something that's maybe not as priced in as much as it should be.
Yeah, if you go back and look at nearly every post-war recession in the US, it was always preceded by rising interest rates. So I think investors have in their mind how they would like things to be, as opposed to how they generally turn out to be. And one thing that we want to try to do here is try to give a real common sense how things are probably going to turn out to be view, rather than looking at anything through rose-colored glasses. So, but I would say that if we do get a decent correction from here, like for me, that would be a pretty good buying opportunity for longer term investors, because when I go through and look at a lot of the stocks in the indices, say the ASX 300, a lot of these stocks have already been knocked down considerably, and it's only the fact that capital has concentrated into some of the biggest names that is masking a lot of these value opportunities that are sitting in the smaller end of the market. So if you do get a good correction from here, like I think that would be an opportunity to really look to invest longer term. You might be underwater for 3 to 6 months, but I think longer term that would be a pretty good opportunity to placing some money. If I'm right about the fact that inflation is going to fall, at least in the short term, interest rates will probably become less restrictive, which will offer some support. So it's not all doom and gloom, but I just think in the shorter term, you probably need to be cognizant of the fact that we might see a bit of a correction, a deeper correction in the market.
Yep, and maybe to sum up, I think it maybe some of the positives here that it's sort of maybe slowly becoming more of a stock pickers market. There will be more opportunities there for the vigilant stock picker who can pick out the opportunities. So that's the positive. And if there are any opportunities, you'll find it here first. And what's not priced in, as you can see from the Qantas example, Greg was there to call it a few months early. So that's the benefit of listening to this show. So if you did like the episode, make sure to subscribe, like, and comment below. But Greg, I'm not sure if we're going to pull off this goodbye because there's a bit of a delay. But thanks for joining me today, and I hope everyone has a great day.
Thanks, everyone. I'll see you next time.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.